You need to be aggressive when it comes to learning new stuff. You need to be aggressive when it comes to new opportunities, and so on. But when it comes to investing, you need to be a bit more conservative.
How's it going, everyone? And welcome back to another episode on Wealth Strategy Secrets of the Ultra Wealthy. I'm your host, Dave Wolcott, and today we are pulling back the curtain on a game most investors don't even realize they're playing and losing. My guest is Robert Rolih, international best-selling author of The $1 Million Decision, a globally featured educator who's helped 7,000 investors in over 70 countries simplify their approach, slash risk, and win long-term. Robert built a fortune as an entrepreneur and then watched most of it vanish by trusting advisors and gurus. That painful wake-up call sent him deep into the industry's black box, where he uncovered the quiet killers that siphon your wealth: hidden fees, conflicted incentives, short-term trading traps, and the dark side of compounding. In this episode, we get ultra practical. You'll learn how small fees become $1 million mistakes, how to build a set and sane portfolio in about an hour a year, why simplicity beats complexity, and how to think clearly about crypto versus stocks, gold, and the debasement trade without getting whipsawed by headlines. If you've ever wondered why average market returns don't show up in your account, or how to create a purpose-driven allocation you can actually stick to, this one's for you. Robert, welcome to the show.
Hi, it's a great honor to be here.
Yeah, it's great to have you on the show, Robert, and excited to really talk about your book. And really, some of the lessons. You've had some massive lessons in your journey of wealth building that I think is always really great to share with the audience. What can we really take away from those lessons learned? And I think yours is really going to resonate with the audience as it did mine. So why don't we kind of begin with your origin story a little bit and tell us, how you were able to really, build your net worth as an entrepreneur and really what happened along the way for you.
Yeah. I grew up in a backwater village in Slovenia. This is a tiny country near Italy. And at the time when I was growing up, it was still a part of the communist bloc. My parents were, of course, poor. They were blue-collar workers, and money was always in short supply. I can still remember my father. He was a very tough guy with this Jimi Hendrix hairstyle. Whenever I asked for something, the reply was always the same: "Robert, we don't have any money. Money doesn't grow on trees." So that was the story of my childhood. And maybe also because of that, I always dreamt about a better life, about becoming someone, about becoming wealthy. And when I was a student, the opportunity presented itself, and I started my own company from scratch. And my first business was web design business. I was basically creating websites for entrepreneurs. And after 5 years of hard work, this business started to produce quite a lot of profits. And at that time, I knew that I should invest part of the money that I'm making, but I didn't know how. I was totally financially illiterate. And that is why I trusted bankers and financial advisors. And I just gave them all of my business profits year after year. And then after years and years and years of doing that, me and my wife, Sarah, we had a conversation. And she said, "Robert, I know that you trust these guys, but maybe just check what is happening with all that money, And okay, I said, let's order all the account statements. And when the envelopes arrived, it was like, what? Are there some zeros missing? Money that I worked hard to earn was mostly gone. And that was the most difficult moment of my life. I became totally depressed. I lost my motivation to work. It was really terrible. So in the next couple of years, it was really a dark period for me. But I was lucky. I was lucky that I knew some very, very successful business owners and public speakers. And one of them was Brian Tracy, the famous author and public speaker. And we invited him in the previous years. Then we invited him to speak to our audience here in Slovenia for 3 times. And after I lost all that money, we had already signed an agreement with him for the next seminar. And after the event, we went to dinner, and I told him all about these problems that I'm having. And he said something that totally changed my life. Robert, it doesn't matter how much you earn. All that matters is if you have the skills to manage your money and to invest it. And at that moment, I realized I don't have these skills. I blindly trust the financial industry. So I made perhaps the most important decision of my life. I will become one of the most financially literate people in this world, no matter what. And then I started to learn all there is to learn about personal finance, about investing, about fees. I talked with a lot of financial industry insiders. I read more than 300 books. I really, started to go into details, and I learned quite a lot of shocking things. And the most important one was that the financial industry is not on our side. Their interests are not aligned with our interests as investors. And that was the biggest lesson that I learned. So I learned that I need to take control of my money. I need to take control of my investments, and I should never trust, just blindly trust some bankers and so on.
Yeah, that story definitely resonates with me as well. Tell us a bit about your book titled "The $1 Million Decision," and what exactly is that decision, and how does that change the trajectory of someone's financial life?
Yeah, the book was really a huge success, and it helped me to build my personal brand. It became an international bestseller, so yeah, it's really a great book. And now the key message is very simple. Small fees you pay when investing can lead to big financial problems. So this is the core message. In the book, I show how even a regular investor, someone investing just, 5,000 or 10,000 per year, can easily lose over $1 million by the time they retire. Now, why? Because of the hidden fees. The financial industry calls them management fees. Now, these fees don't look dangerous at first glance, but over time they quietly compound and rob you of your financial freedom. So yeah, it's really a very useful book. It can be a financial lifesaver. I can tell you a couple of stories. I had a school teacher last time who really, the book basically saved his financial life. Yeah. So if we have a couple of minutes, I can tell you this story.
Yeah, please do.
Yeah, so last year, my youngest child's teacher invited me to give a short presentation about the book to his class. Now, this was a small group of lively 10-year-olds, so it was very interesting, but I tried to simplify things, and it really resonated with them. At the end of the session, I gave each student a copy of the book, and the teacher also took one. Now, a few months later, I got an email from the teacher, and he told me that after reading the book, he began questioning the investments his financial advisor has been managing for years. So he did something that most people never do. He looked at the actual numbers and the reports, and that's when the shock hit. After years of investing, he realized that he was barely breaking even. Meanwhile, the stock market has gone up more than 40% during the same period. Now, I won't reveal the details of his portfolio, of course, but let's say that he had $100,000 invested. Missing out on 40% gain, this means that he's lost $40,000. But not because of the market crash, not because he invested in some crazy crypto meme coins, but because one thing, and that was high fees and poor choice of financial products. And, just by reading the book, just by following, just by cutting costs of his investments. From then on, he is on track to retire much earlier. So instead of facing financial hardship, this teacher is now on track to retire with a solid pension, all because he read one book. So this is really the message. When investing, you need to lower the fees that you are paying, and this will greatly increase your long-term returns.
Yeah, I find it fascinating that we're thousands of miles apart, and we literally have very similar stories with the financial services industry, and many of us in the U.S. have either are going through or have gone through similar awakenings. And I don't know the last time anyone has actually read a mutual fund prospectus, but you might as well get out the tax code and kind of read that as well, right? Because it's complete.
Yeah, but the thing is that even if you read the prospectus, and even if you are aware of these fees, most people don't realize the effect of a small fee over a small management fee that is being charged every single year on your long-term returns. This is something that our psyche is not created to understand. If you pay just 1% management fee to your fund, to your mutual fund, it may sound small, and most people think, it's not dangerous, it's okay, but people don't understand that they don't just lose the 1 year fee, but they lose all the growth that money could have made for you over time, and that's hard to comprehend. So if I just give a simple example, for example, if your portfolio is worth 100,000. Okay, 1% fee means 1,000 in the first year, and that 1,000 is not only gone, but it's no longer growing for you. Okay, and this is something people don't understand. So if the market grows about, let's say, 8% per year, that 1,000 could have turned into more than 10,000 over 30 years. So, and that's just from 1 year of fees. And if you account for all these fees over 30-year span, the total cost is over 120,000 in lost growth. And that's more than your current portfolio value. So a 1% fee doesn't really cost you 1,000 per year. It can cost you financial freedom or delay your retirement by 3 to 10 years. And this is the something that people don't understand.
Yeah, no, that's a great eye opener. And the other two, I think a lot of people miss, and on purpose from the financial services industry, is taxes and inflation, right?
Yeah,
they're only talking about the growth numbers. And so if you're following accumulation theory, building a nest egg, and then you get to the end of that cycle, whether that's retirement or whatever that looks like for you, and you take out taxes, inflation, and fees, that 7% that they told you were getting is probably a lot less than even 4%, which is really disappointing. And then how do you react to that, if you're 65 or 70 at that point?
Yeah, it's probably too late at that time. Yeah. Unfortunately.
Yeah. Interesting. So you also talk about in your book, you call them the 6 dark forces that actually quietly drain investors' wealth. Do you want to break down some of those for us?
Yeah, okay. We already covered a couple of them already. But another one is, for example, short-term trading. A lot of people try to get rich quick via short-term trading, via using options or day trading and stuff like this. But this almost never works. This is a game for professionals. Only a few professionals are winning this game, and most like 95 or 99% of retail investors who try to get rich quick by short-term trading, they lose their investment. Last time I read a very interesting study where they compared going regularly to casino to short-term trading, and they found out that it's more profitable if you go to casino compared to day trading. But we all know, that over the long run, casino or the house always wins. So, but short-term trading, it's even worse. So yeah, that's another thing that people don't realize. And like I said, the dark side of compounding is one dark force that I already mentioned. This is, that the compounding effect doesn't only affect your returns, but also affects the commissions you are paying and the costs that you are accumulating over time. It's really, if you don't know these details, it's really hard to succeed in the investing game. And most people have a hard time by if they just go into investing, and they don't know these details.
Yeah. Let's unpack the trading component a bit, because I think it is quite fascinating that, for one, I do not like casinos at all. Vegas, Monte Carlo. I don't even throw money in the slot machines. It is not exciting to me to be in that gaming. But when I think about investing, right, we have a lot of clients that, one of the biggest missing links is actually having an overall wealth strategy or an investment policy statement that's this, basically strategy or blueprint from which you're going to invest with. And I think a lot of people get often confused with doing daytime trading activities, whether that's in stocks, crypto, or really any asset class. And what's one of the number one, Buffett rules, right? Just don't time the markets. You're not going to win if you time the markets. And frankly, according to Spiva, 88% of financial advisors can't even beat the indices, right? Yeah. So if you're at that, I think the question really on the fee side is, what value is your planner providing for you? And if it's a 1% fee, are they doing some other planning that's really, helpful, maybe for kids' college education, or what kind of value they're creating? But otherwise, you might be better served just using a robo advisor, on the fee side. But in terms of this, trading type mentality, it's a very different mentality than being strategic about your capital, allocate capital on long-term bets. That's how family offices are actually allocating, right? Which is looking at 10 and 20-year horizons and macro trends. And they know their capital is going to be locked up for a long period of time, and they don't need that liquidity. If you want to play the liquidity and trading game, just allocate a certain percentage of your portfolio to do that, and think about it very differently. Yeah.
That can be like, you can take 5% and play with it, but you need to understand that you will very likely have terrible returns with that money. Most people, if you are not a professional, if you don't have like a 5-year experience or 10-year experience. So it's this time horizon is one of the most difficult things for people, because most people are short-term oriented. And they think maybe 6 months in advance, maybe 1 year. When it comes to successful investing, you need to have at least, let's say, 10-year time horizon. If you don't have it, then you will panic every time the market drops sharply, like it happened in April when we had this situation with tariffs. Everybody thought that we are going into a recession. The stock market went down 30%. Everybody was selling. The fear and the greed index went to 4 out of 100. And at that time, most people were selling in panic. Me and also my followers, we were heavily buying at the time. I issued a couple of very profitable, now when we look back, very profitable signals, buy signals at the time. And I said, I'm buying, this is a great opportunity. So if you don't have this long time horizon, and if you don't have a positive outlook on the world, on the future of the world, then you will always panic when there is some fear in the market. But I always believe, as an investor, I always believe that the world will be better tomorrow than it is today, because throughout human history, we are living at the best of times. In human history. Never in history of mankind we had such a great quality of life, so many opportunities, so much money, so much free time, and so on. So it's really sometimes when I see some doomsayers predicting the next big crisis every single year, I just laugh. But they scare people and people sell. Yeah.
Yeah, I think another good strategy for clients, one of the things that we kind of work through is actually creating a purpose-driven asset allocation model. And really, before you get into which asset class, you want to invest in, you need to really break down some of those things that you're looking for. Are you looking for liquidity? Are you looking for safety of principal? Are you looking for growth, right? And what is the pacing and time frame with which you're looking to achieve certain things? Maybe that's financial freedom or whatever that number is. But that can help you really psychologically allocate better. And it's interesting because a lot of people in the industry will talk about private equity. One of the downsides to private equity is that you have, basically it's locked up capital. So you don't have that liquidity for whatever period that may be. But in some ways, I find that is actually a benefit. Because not having access to capital makes you, avoid the psychological and emotional ups and downs and trying to time the market. And, tariffs are coming, they're not, I need to get in, I need to get out, and trying to, do all of those things. Maybe you can do that on a smaller portion of your portfolio, but really don't want to upset the overall strategy.
Yeah, there's a funny story. We don't know if it's true or not, but probably it would be true if they really did this research. One of the brokers researched which clients are the most profitable ones, and they realized that the most profitable clients are the ones that are dead or forgot the passwords for their accounts. So if you are forced to leave your investments alone and not touch them, you will be much more successful than people who are constantly trading in and out of the market.
Yeah, that's funny. So, Robert, I know you also have some expertise around crypto and everything, and so I mean, why don't let's talk about crypto? What's your thesis here? And let's talk about the debasement trade right now. Should we be getting into crypto and gold, or what are your thoughts there?
I think it's a bit late now. Crypto, Bitcoin went from 16,000 to 126,000. And it's quite normal that we will see maybe a bigger drawdown in the coming year. Maybe, 50% for Bitcoin, maybe 60%. I don't think it will go like 80% like it did in the previous cycles, because now there are a lot of institutions involved that were not there in the previous cycles. So Bitcoin, of course, is now much more trustworthy asset than it was 4 years ago. But when it comes to crypto, I put cryptos into 3 buckets. The first bucket is Bitcoin. Bitcoin is a digital store of value. It's a digital gold. Simple as that. So it's a new gold for new generations. It's very safe, it's liquid, it's very easy to send to someone, very inexpensive to send to someone, very easy and inexpensive to store. So it's basically improved digital gold. Okay, so this is a store of value asset. The second bucket are big crypto infrastructure projects like Ethereum, Solana, Sui. These are so-called layer ones. Now, if I try to simplify this, layer ones or big cryptos, these are like operating system for your computer. Different developers are creating apps on top of these blockchains, on top of Ethereum, on top of Solana, and so on. So think of Ethereum and Solana as an operating system. And there are thousands and thousands of developers who are creating apps on top of this blockchain. Or on top of this operating system. And then we have everything else in the crypto space. There are hundreds of thousands of different small coins, meme coins, small cryptos. And I think that the only path for this third bucket is that they will gravitate towards zero. So this third bucket is totally uninvestable because there are too many projects, too many meme coins, too many of everything, and because liquidity is limited, all of these, in general, all of these small coins will basically go to zero. So the only investable thing in the crypto space is, of course, Bitcoin. Bitcoin, I believe it has a great future. If you are a long-term investor, if you just regularly invest in Bitcoin, you will very likely do okay. And big cryptos also, if you stick to really the best, biggest projects in the crypto space, I believe that also if you regularly invest, you will do okay over the long run. Now, of course, some of them will give you great returns. Maybe some of them will go to zero. But if you spread your investments over, I don't know, 4 or 5 of them, probably you will be okay. So this is my take on crypto. But would I invest now in Bitcoin? My answer is no. I am sitting on huge gains because we in this cycle we started to invest in Bitcoin at 16,200. I know that because that was the day when Jim Cramer on CNBC was telling investors, "Get out of crypto while you can." And the very next day, I sent to all my members, all my clients, I sent an email and I said, "Jim Cramer said that. Let's start to invest in crypto again." And that was a great call. But now, of course, Bitcoin has gone up I don't know, 700%. So it's hard to imagine for me that it will just go straight up in the next couple of years. I think that we are due for some kind of bigger correction or maybe a bear market. So I'm cashing out and I will start to invest again in crypto in maybe, I don't know, in the end of 2026. We will see what the market brings us,
Yeah. And how about gold and silver? What are your thoughts there?
Gold is an asset that has been around for thousands of years, and in the recent history, gold has kept pace with inflation. If we take a look at the long time period, but of course, from time to time, gold has this surge where it goes really, sharp up move, like it did in the last 2 years. But again, if you start to invest in gold now, or when it already went up a lot, I'm not sure that you will get great returns. Again, I was investing in gold in the past years. But in 2025, I have not added anything to my gold investments. And now, recently, I sold 60% of my gold. that I had as an investment. I have some physical gold also as a something for safety. I don't touch that. That is my, I will never sell that because it's just for safety if the world goes to hell, for example. But the likelihood of this happening is very, very, very low. So yeah, I keep some physical gold for safety, but and I will never touch it, until I die. And I hope that I will never touch it. Yeah.
Do you have any concerns about fiat currency right now?
Yeah, sure. Fiat currencies are being debased all the time. Money printers are running all the time. So if you are in cash, it's not, in my opinion, it's not a good decision for the long run. It's of course you need to be invested in the stock market. You need to be invested in crypto. You need to be invested in real estate. You need to be invested in hard assets. If you are in cash, you can be pretty sure that your purchasing power will go down sharply over the next 5 to 10 years.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve.
Yeah, you also talk about the psychology of simplicity in your book. And you talk about, many of these talking heads in the financial services world really trying to overcomplicate investing. Have you seen any mental traps or biases that can really, lead them to chasing performance or trusting the wrong advice?
Yeah, we humans, we are strange beings, especially investors. We try to invest in a lot of things. We are chasing gains here and there. But usually the simplest strategies are the most profitable ones. For example, my wife, she only has 2 investments. She is investing most of her money into a global ETF, so global index fund, low-cost ETF, of course. This is stocks, and she also invests in technology ETF. That's it, And if I compare her results to, for example, Warren Buffett's results, she's outperforming Warren Buffett since she started, with no problems, because she is just investing in a whole market for the lowest possible fee. And Warren Buffett is, of course, quite old already. And when you are too old, you become too conservative with your investments. So when you are young, as an investor, you are risking too much. I also did that. I went into all sorts of crazy investment opportunities, and usually I lost money when I tried to be too aggressive. And when you are too old, you become too conservative, and you are too careful. You have a large part of your portfolio in cash, and of course, usually this is not good in a world of consistent money printing, inflation, monetary inflation. So, yeah, you need to be invested. Of course, it's always good to have some cash on the side for opportunities, but I'm not trying to overdo it. I'm not trying to have 50% of my portfolio in cash, because that would be crazy. Yeah.
Robert, so, if you could give just one piece of advice to the listeners about how they could accelerate their wealth trajectory, what would it be?
I would say maybe I would follow my one of the quotes from my book. Take a lot of risks when it comes to making money, but don't take a lot of risks when it comes to investing. So when it comes to money making, for example, if you are an entrepreneur, you need to risk. You need to take some risky bets. You need to produce new products and services, and you know that some of them will not succeed. Or if you are an employee, you need to maybe learn some new stuff. You need to be aggressive when it comes to learning new stuff. You need to be aggressive when it comes to new opportunities, and so on. But when it comes to investing, you need to be a bit more conservative. You shouldn't go into all sorts of crazy get-rich-quick opportunities, and this is usually the winning combination. So don't risk too much when it comes to investing, but of course take quite a few risks when it comes to money making.
Yeah. Excellent. Well, appreciate your insights and wisdom today. If people would like to connect with you or learn more, what is the best place?
Well, I'm running a free 90-minute masterclass, online masterclass, where I teach people all about long-term investing, the fees, and I also share my best investments for the coming 5 to 10 year period. So if you go to my website, robertrolih.com, so it's Robert, ROLIH.com, or you just put my name and surname into Google, you will end up on my website, and there you will see the registration form. It's totally free of charge.
Great. We'll make sure to put that into the show notes. Robert, thanks so much for coming on today and sharing all of your different insights with us. Appreciate you.
Thank you for inviting me. It was great.
Thanks.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.